So what are the key tax issues I'm seeing in single family rental? I think the main tax issues are VAT, SDLT and corporation tax. And it's really important to think about those early on because tax can be quite a major cost if you get the structuring wrong. But if you think about it early enough in the process, it's quite easy to mitigate most of the tax charges. In respect of VAT, not being able to recover VAT is a potential 20% real cost for the company, so it's very important to get that right. With proper structuring, it's possible to usually recover the whole of the VAT, other than things like white goods are the exception to that. For SDLT, it's important to think about if the commercial rates or residential rates of SDLT apply, and whether any relief such as multiple dwellings relief are available. It could also be advantageous to acquire the shares in a property owning vehicle if that is possible. In respect of corporation tax, businesses obviously expect to pay tax on their profits, but it's important to make sure those tax charges only arise once the income's actually coming into the company and that you don't suffer a dry tax charge. There's three different main categories of VAT that could apply. Supplies can be standard rated, i.e. subject to VAT at 20%. They can be zero rated, which means there's VAT at 0%, or they can be exempt, which means there's no VAT, but it has an impact on recovery. Businesses are able to recover VAT they incur in respect of standard rated or zero rated supplies, but they can't recover VAT they incur in relation to exempt supplies. So exempt supplies are generally a bad thing for a business to be making. So when we're looking at the VAT position of the structure, we're trying to minimise any VAT leakage on exempt supplies. The first step is to minimise any VAT incurred in the first place. This involves thinking about the VAT treatment of the acquisition of the land and the construction of the property. The first thing to think about is the VAT treatment of the acquisition of the land and the construction works. So the acquisition of the land could be VATable, standard rated, if the seller has opted to tax the land and it's commercial or bare land, or it could be zero rated if the residential development has started and you've got beyond what's called golden brick stage. Golden brick is simply the layer of bricks above the foundation level. At that stage, a sale can be zero rated, such that the developer doesn't incur any VAT on the purchase. To the extent a developer does incur VAT in respect to the development, to recover that VAT, they need to be making a zero rated supply of the property. And the way we deal with that is generally granting a lease for more than 21 years to a group company. It tends to be called a VAT lease. And the benefit of that is that it allows you to zero rate that supply and recover the VAT you've incurred in respect to development. So for that reason, it's important that the developers don't make supplies of less than 21 years or other exempt supplies of the property before making that zero rated grant. In terms of the building works, they are generally zero rated in respect of residential property. Architects' fees and certain professional fees might be standard rated and VATable, but this is a point that should be covered off in the building contract to make sure there's no misunderstandings between the parties. So another way of minimising the VAT on acquisition of the land is to structure the transaction as a TOGC. That stands for a transfer of a going concern. It applies where there's a transfer of a business from one party to another, and the result of that is that the transaction falls outside the scope of VAT, so there's no VAT chargeable. So that's a good thing for the purchaser. TOGC treatment applies where there's a transfer of business. Business is a very broad concept and can include a property rental business, or it could be a development business, which is quite often looked at in this context. Obviously, with an election on the horizon, there's the increased prospect of changes in the tax system. The government's clearly going to be looking to raise further revenues from taxpayers. The corporation tax rate obviously increased to 25% recently. Probably unlikely that will come down anytime soon. A simplification of the SDLT rules would be really welcomed, given it's become very complex recently. Also, it would be worth looking at the thresholds for the various bands of SDLT, given house prices have gone up over the past few years. That unfortunately seemed unlikely. SDLT is a bit of a political hot potato. Frequently there's discussions about whether it should be a buyer's or a seller's tax and the impact it has on the market, the housing market. Also recently there's been a lot of discussion about a land value tax, which would negatively impact developers' returns. So we'll just watch this space in terms of see what comes next.